When you reach retirement, one of the biggest questions isn't just how much you've saved, but how much you're actually going to get to keep after you pay your taxes. And that is because different sources of retirement income are taxed in different ways. And if you don't have a clear plan, you could end up paying way more tax than necessary. Worse yet, you could even trigger that dreaded OAS clawback. In this video, we're going to walk through how you as a Canadian can manage your retirement income in the most tax efficient way possible. I'm going to break down some common retirement income sources, how they're taxed, the smartest way to withdraw your funds, and some of the biggest tax mistakes that retirees make. By the end of this video, you'll have the information that you need to make smarter decisions and keep more of your retirement income. This is episode 3 of our 12-part series called Second Act. And over the series, I'm going to walk you through how to create a retirement plan that fits your needs. We're going to explore everything from setting clear financial goals to navigating the emotional transfer of leaving the workforce, helping you feel more confident and prepared for every stage of retirement. I would like to take a moment and say thank you to Harvest ETFs who have partnered with us for this entire series. I'll be talking a little bit more about them later in the video. Let's start today by looking at some of the most common sources of retirement income in Canada and how each one of those is taxed. Old Age Security, OAS. This is a government pension that most Canadians can start receiving at age 65, although you can actually delay it up until age 70. The best part of this, you really don't need to do anything special in order to get it. If you have lived in Canada for 10 years since you turned 18, you're going to get something. If you've lived here for more than 40 years, you qualify for the full benefit. But there is a catch. All of your OAS income is fully taxable. And if your income is too high, you could actually lose some or all of that benefit. Technically, I'm talking about the OAS pension recovery tax, but most of us know it as the OAS clawback. Now, in 2025, if your net income is over $90,997, you will start losing 15 cents of OAS for every dollar over that amount. Once your income hits $148,451 from 65 to 74, or $154,196 for ages 75 or older, your entire OAS will be clawed back. Now, you probably are curious about how much OAS you'll actually get paid. We're going to cover all of that in episode 6 of this series, so subscribe so you don't miss anything. Now, the Canada Pension Plan, CPP, this is another major source of income for Canadian retirees. Yes, it too is fully taxable. You can start collecting your CPP as early as age 60, or you can delay that until age 70. If you start early, that reduces your payments. It's 0.6% for every month you take it before age 65. If you start taking it at age 60, you're going to get a 36% reduction. But delaying does the opposite. It increases your payments by 0.7% for every month after age 65. So that equals a 42% increase if you wait all the way to age 70. Now, if you are married or common law, both at least 60 years old, and are receiving or have applied for your CPP benefits, you can apply for pension sharing. And this strategy allows couples to potentially reduce their overall tax burden by allocating pension income from the higher earning spouse to the lower earning spouse. The portion of CPP benefits that can be shared is based on the number of months the couple live together during the joint contributory period. And that starts when the older spouse turned 18 and it ends when both are receiving their CPP pensions. I'd like you to meet Robert and Karen to see what they did. Robert, who had a higher income, decided to delay his CPP pension until age 70 to maximize his lifetime benefit by approximately 42%. Now, Karen, on the other hand, she had a lower income. She chose to start her CPP at age 65. Now, to balance their taxable income, they applied for CPP sharing through Service Canada that allows part of Robert's higher CPP entitlement to be allocated to Karen. So this strategy helped to reduce their overall tax burden and ensure a more even distribution of retirement income. Now, next, I want to look at registered retirement income funds, or RRIFs. And by the end of the year that you turn 71, your RRSP must be converted to a RRIF or an annuity. And if you haven't seen episode 2 of this series, I will put a link here so you can review and learn more about this, how to convert your RRSPs to a RRIF, or the other options you have there as well. Now, once you set up your RRIF, you are required to start taking minimum annual withdrawals. And yes, you guessed it, those two are fully taxable. Now, you also want to be aware that while there isn't withholding tax on the minimum RRIF withdrawal, you might still end up owing tax at year end. The amount that you do withdraw is added to your total annual income, and that will be taxed at your marginal tax rate. Now, some people here, they choose to voluntarily withhold some tax, but that's entirely up to you. Now, if you are married, don't forget about income splitting. So at age 65 or later, you can split up to 50% of your RRIF income with your spouse. Again, that can help reduce your overall tax bill. Now, if you're single, you may have a simpler life, I'll say, but you certainly don't have the splitting option, so early planning is even more important. When Canadians need to wind down their RSPs, they also have the option of purchasing an annuity. And understanding the difference between types of annuities is critical, especially regarding tax implications. Registered annuities are funded from registered accounts, such as RRSPs or RRIFs. These annuities are fully taxable at your marginal tax rate, and this can increase your taxable income, possibly pushing you into a higher tax bracket or causing a reduction in your OAS benefits through those clawbacks. Now, non-registered annuities, on the other hand, they are purchased with after-tax money. So only the interest portion of each payment is taxable, while the return of capital is tax-free. Then, just to keep things interesting, when you are purchasing a non-registered annuity, you can choose between a prescribed or non-prescribed annuity, depending on how you want the taxable portion to be structured. A prescribed annuity spreads that taxable interest portion evenly over the entire lifetime of the annuity. So this provides stable, predictable taxable income each year, and it helps to reduce sort of tax spikes that could push you into a higher tax bracket or trigger an OAS clawback. Now, prescribed annuities are generally best for retirees who expect their tax bracket to remain the same or possibly even decline over time. Now, in contrast, a non-prescribed annuity, this has a higher taxable portion in the early years that declines as time goes by. So this option can be useful if you are currently in a lower tax bracket, but you might expect your income to raise later, perhaps due to higher RRIF withdrawals, government pensions, investment income from other sources, for example, property sales. By paying more tax upfront while your tax rate is lower, you can reduce your taxable income in later years when you might be in a higher tax bracket. The big question, of course, is which one should you choose? Well, a couple of examples here. Susan is 70 years old and she has no additional income beyond OAS and CPP. What's most important to her is she has consistent tax treatment. A prescribed annuity ensures that her taxable income remains stable throughout her retirement. Now, Mark, on the other hand, he is 62 years old. He currently has little taxable income, but he will have a large RRIF withdrawal at age 72. So he chooses a non-prescribed annuity, and then he pays more tax now while he's in that lower tax bracket. That reduces his taxable income when he's in his 70s. The tax bracket then, of course, will be higher. Now, to help you navigate through these options, I've put together a summary of all the key takeaways of the tax strategies covered in this video. You can download it from our website. Just click on the link in the description or scan the QR code on your screen. Okay, we've covered how your income is taxed, but let's look at some strategies to make these withdrawals as tax efficient as possible. Most retirees have multiple sources of income. I think of things like CPP, OAS, possibly the guaranteed income supplement, pension plans, RRSPs, TFSAs, non-registered accounts, annuities. In some cases, you may have rental or business income as well, and this doesn't even cover all of them. This is where I get to what's called income sequencing, and this is a very important strategy for retirees who are looking to do three things. First of all, reduce taxes, preserve government benefits, and maximize your retirement savings plan in your estate. Now, the order in which this retirement income is withdrawn can have a big impact on your long-term financial outcome. The goal of income sequencing is to manage when and how much you withdraw from each income source to reduce your overall taxes, minimize the risk of those OAS clawbacks, and ensure efficient estate planning. Proper sequencing can also help you remain eligible for government benefits and other credits. Now, a common approach to income sequencing starts with non-registered accounts, followed by RRSPs or RRIFs, and then finally TFSA withdrawals. Now, the logic here is that if you defer your taxes as long as possible, you get more compound tax-free growth, and that makes sense, right? Well, I'm here to say maybe not. When the TFSA was introduced back in 2009, that changed the game for everything. In some cases, following the traditional approach can actually lead to higher taxes later, larger forced RRIF withdrawals, and even OAS clawbacks. In a minute, I'm going to explain why this order may be wrong for you and what you might want to do instead. But there are still a lot of people who follow this approach, so let's walk through that first. Let's start with non-registered accounts or taxable investments accounts, and these are often used as that first source to draw from because they contain after-tax money. So selling investments in these accounts can trigger capital gains but only 50% of the gains are actually taxable. So because the tax treatment is preferable to withdrawing from registered funds, this is often considered to be the go-to account. Next in line are RRSPs and RRIFs. Now, of course, withdrawals from these accounts are fully taxable. But as the thought process goes, if you leave these untouched, you're going to generate that tax-free growth for longer and you're going to come out ahead. Now, again, that might not be the case. Lastly, TFSA withdrawals are preserved for later years. So the withdrawals here, those would be completely tax-free. They don't impact any government benefits or taxable income. So that makes them ideal for bridging income gaps in later retirement or for managing taxes during high income years. Now let's look at an alternative sequencing scenario here. If you withdraw RRSPs before converting them to a RRIF or start before government benefits, that can actually be a smart move. This can help to reduce large forced RRIF withdrawals later. That can push you up into a higher tax bracket. It can minimize the risk of OAS clawbacks by controlling taxable income. As an example, David is a single retiree and he withdrew $15,000 a year from his RRSP starting at age 60. Now, by doing this, he reduced his RRSPs before that mandatory conversion at age 71. His mandatory withdrawals were much smaller. That kept him in a lower tax bracket in his 70s. Because of this, he avoided unnecessary OAS clawbacks while he still benefited from the RRSP tax deferral. If he had waited until age 72 to start withdrawing, his required RRIF withdrawals at that point would have been much higher. That would have pushed him into a higher tax bracket, potentially reducing his government benefits. Then we move to non-registered accounts and TFSAs. Now, retirees can, of course, withdraw from taxable accounts from their RRSPs at any time, but you can make very good use of a TFSA by withdrawing during years where your taxable income might spike. Because the TFSA withdrawals aren't considered taxable income, they can help your overall income levels stay lower. Now, a perfect example of this is Rob. As a retiree, he sold a property and he faced a large capital gain in 1 year. Now, if he had withdrawn from his RRIF in that same year, his total taxable income, that would have skyrocketed, that would have triggered higher tax rates and OAS clawbacks. Now, instead, he withdrew from his TFSA that year. That allowed him to cover his expenses without adding to his taxable income. So this one simple strategy saved him thousands in taxes and it kept his OAS benefits intact. There is no one-size-fits-all approach to income sequencing. The traditional approach might work for some, but for others, you're going to want to benefit from a customized withdrawal strategy based on your own tax situation, your investment mix, and your retirement goals. Now, if you want to explore this topic further, I highly recommend checking out Adam Bourne's YouTube channel, Parallel Wealth. In the description of this video, I'm going to list some of his best videos on income sequencing to help you make the most informed decision. For couples, pension income splitting is a valuable tool for managing taxes. As of 2025, Canadians 65 and older can split up to 50% of eligible pension income, and this includes RRIF withdrawals. So if you use this strategy, it can significantly reduce taxes for couples, especially when one spouse is in a higher tax bracket. Meet Judy and Alan. This is a retired couple with uneven incomes. Judy is a former executive. She has a larger RRIF balance and other taxable income sources that puts her in a higher tax bracket. Alan, on the other hand, he has minimal taxable income in his retirement. Now, without any tax planning, Judy's RRIF withdrawals would be fully taxed at her higher marginal tax rate, while Alan's lower tax bracket would probably go unused. Now, to reduce their overall tax bill, they decide to use pension income splitting. They allocate 50% of Judy's RRIF withdrawals to Alan, and they can effectively shift some of that taxable income from Judy's higher bracket over into Alan's lower bracket, and that makes a big difference in the couple's combined tax burden. Judy also lowers her taxable income, and that avoids a higher marginal tax rate. Alan makes use of his lower tax bracket. He keeps more of the money in the family. Together, they reduce the risk of OAS clawbacks by managing Judy's taxable income more efficiently. So this one simple strategy saves them thousands of dollars each year. I want to look now at some of the biggest mistakes that Canadian retirees make. But first, I would like to thank Harvest ETFs for partnering with us throughout 2025 to bring you this very important series. I've talked a lot about RRSPs and RRIFs, but for Canadians who are planning for retirement, managing tax exposure in non-registered accounts, that's also critical. Harvest does offer a potential solution to their equity income ETFs. This uses covered call strategies to generate income. Now, registered accounts like RRSPs, RRIFs, TFSAs, of course, they do provide tax advantages, but their contribution limits can restrict savings. Non-registered accounts, on the other hand, they have no limits, but they do expose investors to taxes on growth and income. Capital gains are taxed at 50%, while interest income is taxed at the full marginal tax rate. Covered call strategies here, they can offer a more tax-efficient income stream for retirees. Harvest ETFs, they generate a significant portion of their distributions by selling covered call options. And in Canada, the premiums from these options are treated as capital gains, meaning only 50% of that is taxable. This can help reduce your overall tax burden on retirement income. Now, not all income from these equity income ETFs come from covered calls. Some also include dividends from the underlying stocks. Those are taxed differently. So understanding the mix of income sources, that's a key to effective tax planning. Every investor situation is unique, so professional advice is essential. Now, another resource Harvest has is what's called their Insights, and that is an excellent source for additional retirement tips, including these excellent articles that help Canadians better understand tax-efficient retirement income. You can scan the QR code on your screen to learn more, or visit harvestportfolios.com. I will put a link in the description of this video. Okay, let's talk about some of the most common mistakes that Canadian retirees make. And some of these mistakes, they can cost thousands, tens of thousands, or even more throughout the course of a retirement. The good news here is that with a little bit of planning, these mistakes are completely avoidable. Mistake number one, delaying RRIF and RRSP withdrawals. In many cases, waiting until age 72 to start withdrawing from your RRIF or leaving large untouched balances, that can result in substantial mandatory withdrawals later. This might push you up into a higher tax bracket that could trigger that OAS clawback, and it could create a tax burden for your estate. Now, instead, you can consider making smaller voluntary withdrawals in your early 60s or during your lower income years. By spreading out the withdrawals strategically, you can smooth out your income. Also, shifting withdrawn funds into a tax-free savings account that allows for continued tax-free growth, and it further reduces the tax impact on your heirs, is effectively it manages both your retirement income and your estate planning objectives in one move. Mistake number two, taking CPP or OAS too early. Taking your CPP payment at 60 or taking your OAS at age 65, that can permanently lock in lower payments. Now, early payments might seem appealing, but they could leave you with less income later when you need it the most. If you delay CPP or OAS, it can mean a larger lifetime payment and more flexibility to draw down other taxable accounts first, and this can reduce your overall tax burden. I've gone into this with examples in previous videos. I will put a link here so you can learn more about this concept. Now, mistake number three, ignoring the OAS clawback. Large unplanned withdrawals or sudden income increases can easily trigger that OAS clawback. Now, some examples of this are the sales of a stock or an ETF, an investment property, or perhaps shares of a business, lump sum RRIF or RSP withdrawals, lump sum payments from an employer pension, a severance or buyout package, or even unused vacation pay or bonuses. Now, to avoid this, you need to monitor your income every year and consider using TFSA withdrawals in high income years, since they don't count as taxable income. Be strategic with the timing of your withdrawals. That can help protect your OAS payments. Mistake number four, not splitting your pension income. Failing to split pension income can lead to unnecessary taxes for couples. If you split your eligible income, like the RRIF withdrawals, that can reduce your overall tax bill. It's a very simple strategy. It's available starting at age 65. Tax-efficient retirement income planning isn't just about how much you've saved. It's about how much you can withdraw and manage those funds over time. The right strategy could save you thousands of dollars or even more, and help make most of every dollar that you've worked so hard to save. On your screen, you will see a link to the playlist for the episodes of this series you might have missed. Thank you for watching. Here's to a great retirement.